does it make sense to have a life insurance policy that earns only 4%, but when I borrow against it, I have the control cost at 5%? If I just sit here and think, if I have to earn 4%, but I'm borrowing at 5%, when does that ever make any sense? Well, here, what we're going to do is we're going to look at some numbers and we're going to give an example of when it could make sense and when it wouldn't make sense. So let's go ahead and dive into that and let's get after it. So first and foremost, here I'm going to share with the contract what we call a front load policy, where essentially we take $500,000, we then dump it into the policy. You can see over here is our net cash value, which is about 467 of cash value that you have access to at the end of the year. You can access about 90% of this within the first 30 days. And then after that, we're putting about $100,000 into the contract, therefore after. So what we're going to do is we're going to do a little experiment and talk through this out loud of, does this make sense to be able to borrow from a policy where I am paying 5%? So if we're looking at this specific contract, this company saying, okay, if you want to use your funds and access that, we're going to charge you a control cost of 5%. But we're going to assume that long-term that this is going to earn us 4%. Now, everybody's going to be different. The way that you design it, the companies you use, age, gender, there's a lot of different factors. Health is going to be a big factor too of what your actual internal rate of return is going to be. But we're just going to use a standard 4% because it makes it easier for us to do a little case study from a standpoint of, does it make sense or does it not? So first and foremost, I kind of just want to point out a few things, right? When we're looking at this policy from a dollar for dollar access, I put in a total of $800,000 within year 4, and I finally have $809,000 back. Okay. So when I'm looking at this policy, I finally have more cash value than I put in, and it took 4 years to do so. When I look at this and I put in $500,000, I only have 467. If I'm going to use this example as a 4% rate of return, that math doesn't work out because I put in 500 and I'm actually at a negative dollar amount than I actually have control and access to. But something to point out is that in year 2, I put in $100,000, but my cash value increased by $107,000. So I finally put my cash into a place where I put my dollar in, and I am now getting more than that dollar back. So in a bank account, I put in $100,000, 0.002%, you're not going to get really anything back. In this instance, I put in 100 grand, I get 7 grand back, and it's going to keep continuous. I put in 100 grand, I get about 113 back, so $13,000. So you can kind of see this column here is the column that shows how much it increases by. But from an actual dollars that we have more than we put in, which is kind of important to look at from a comparison standpoint, this specific example is showing 800,000 and we have $809,000 in. All right, so now back to the question. If I'm earning 4% and we're going to assume that this is going to earn 4% and over a long period of time, this policy specifically would earn above a 4% rate of return. So we're just going to assume that flat across the board, and we're going to borrow at 5% just to use from an example standpoint. All right, so here's what I will say. If you are going to borrow and max leverage against your policy completely, fully the entire time you have this policy, and you're never making any loan payments or interest payments back, then in reality, it really does not ever make any sense to use this as a cash play to focus on, because what's going to happen is you're going to have interest that's going to compound on top of interest, that's going to compound on top of interest indefinitely. And mathematically, if you only earn 4% over a long period of time and you're borrowing at 5%, well, then you're not going to be at a net win, right? Now, there's some things to consider. I've looked at and talked with this with other real estate investors and other people. And they said, well, if I borrow from against my policy and I go use it for real estate activities and I'm earning other cash flow, assets are increasing, so on and so forth, other places, and I still have a permanent death benefit that'll essentially last me forever, well, then I've had it in the rare one-off cases that it makes sense for that person. But I would say for about 99% of people, if you're going to over leverage this policy, and I use the word over leverage because you're max leveraging it to the T, insurance companies will typically only allow you to leverage only about 95% of the cash value anyways, because they don't want the policies to lapse. But if you're going to fully leverage this policy and never pay any of the loan interest back or anything like that, then I'd say this is not a good tool for you. All right. The thing about this policy and this contract and the way we design it is that this only is good as essentially the contractor who's using it. It's the same concept when we're building homes. You're only as good as building a home as you are from a knowledge standpoint. The hammer, the tool, that specific tool, is only as good as the person holding it, right? It's the same as with sports. When I used to play football, I used to play professional football. The football in itself meant a lot to me. It was worth a lot of money. The football to somebody else who's a master chess player, that football means essentially zero to them. It's the same thing in this concept. How we use it and using it appropriately and responsibly is super important at the end of the day. All right, so I just wanted to share that because when we're borrowing against and we don't pay any of the interest back, the interest compounds on top of each other. When we pay the interest back, the interest becomes simple interest, right? If we have a full interest and we pay that back, it's now simple interest. Simple interest is going to be way more powerful than compounding interest over a long period of time, obviously. We don't want our interest to compound, but when it's on the negative side, we want our interest to compound on the positive side. So now let's go ahead and take a look at the math and just kind of take a peek at this on when it would make sense to essentially earn 4 and borrow at 5. So first and foremost, you're going to take a look and we'll see here, year one, we have 467 of net cash value. So let's use an example and say, hey, we're going to borrow right off the bat $100,000. I'm a real estate investor. I need $100,000 for a couple of properties that I have opportunities for that are going to go earn me 20% somewhere else. I need to have access to that capital. So you call up the insurance company and say, hey, I want access to $100,000 of my total cash value that I have available. So we're going to say that we have a total of 467 available, or we're going to borrow 100,000. So if we borrow $100,000 and we do that at a control cost at 0.05, which is essentially 5%, the cost is going to cost $5,000 to essentially borrow against and to have control of that 100K. Now, here's something to consider. We're not looking at arbitrage. That's not important. But in this one instance, we did have arbitrage. Why? Well, we put in $100,000. We have a $107,000 increase. So we made $7,000 on our policy, right? But we had a control cost of $5,000 to be able to go use that. So now we have $100,000 that's go earning us 20% somewhere else. And I just use 20% as the arbitrage random number. Could be 8, 7, 10, anything greater than the control cost of 5%. We have our dollars doing multiple things. It's earning us dollars over here somewhere else. But in our policy, we actually earned a total of $2,000. Okay. So in that instance, arbitrage at its finest. Now, best case scenario, what ends up happening, we took our $100,000, we're over there earning cash flow. That cash flow is going up. We're able to take that cash flow and be able to pay off that $5,000 interest payment. So now it becomes simple interest, which then allows us to continue to borrow again because it's just a continuous revolving line of credit to be able to use. Now, here's where this becomes, I would say, somewhat detrimental because let's use this same example. But in this instance, instead of using $100,000, we're now in this instance of we borrow $400,000. You borrow $400,000 at 0.05. We now have a control cost of $20,000. Well, year two, like we mentioned, you made $7,000, but your control cost was $20,000. So in this instance, if we're looking at it from an arbitrage standpoint, which I don't like to talk about arbitrage in life insurance because I don't think that is what's important. I think from a standpoint of all of the key benefits that it has is really the key thing to focus on, and how we use it is really the key thing to focus on. But when we're looking at straight math, the control cost was $20,000. We made $7,000. So from that arbitrage, we lost $13,000. But what ended up happening? Our dollars are compounding for us for the rest of our life. This $467,000 did not leave the policy. It is growing. It is compounding. It'll always continue to compound. What would have happened if we would have taken that same $400,000 and just spent it? It would be gone for the rest of our lives. So in this instance, we are able to have our dollars do multiple jobs. Yes, in this one instance, I'm leveraging it to the max. I'm taking a $400,000 loan. I have a negative spread of $13,000. But if I look at it then back to my real estate that's growing me, let's say 20% because it's easy math. Well, let's use that same example of $400,000 now earning us 0.2%, $80,000. So you made $7,000 in your policy, you made $80,000 in the real estate, but the control cost was $20,000. So it's an $87,000 of actual growth coming into you as a household economy of cash flow, right? but you had an output of 20 grand. So the difference between the two is 87 minus 20, which is essentially $67,000 of positive arbitrage. That's why this is so powerful when we're using it for other asset-based activities that are going to actually earn and produce cash flow. And at the same time, we had an $8 million death benefit if something were to happen to our family, God forbid, any case scenario, all right? And that's just the beginning. As we later on have this policy and we continue to grow and compound, right? We put in 100,000 and it grows by 226. So now it grew by $126,000, which means now we have more of a leeway where we can borrow more money, where we're going to make more versus from the arbitrage standpoint. So here's what I will say to kind of tee this off. As a whole, right? If I'm going to borrow the full amount, over leverage myself continuously, never pay anything back, well, then it doesn't make any sense. You're going to be underwater. And from a mathematical standpoint, no bueno. Now, if we have large lump sums of money and we borrow pieces of it, 100,000 at a time, 200,000 at a time, but we have it growing faster than what we're borrowing at, from an arbitrage standpoint, it's even great. But the most important thing when we're looking at the and asset infinite banking policy is that whatever we borrow, again, whenever we borrow against our policy, when we're using it for another activity, that activity is going to be more than what we're borrowing at. So if it's 5% here, we're getting 7, 8, 9, whatever percentage higher, right? Then we can use that cash flow to pay off the interest here, which then allows us to continue to keep borrowing from our policy to go use for more asset producing activities. At the same exact time, we still have our death benefit that's growing, everlasting for the rest of our life as well. You will have this permanent death benefit forever. All right, so I hope that answers your question. Does it make sense to borrow at 5% when you're earning at 4%? The answer is yes, if you use the tool appropriately and you are able to allow your dollars to do multiple jobs. And the other thing is you have to ask yourself too, is when we're looking at this from a standpoint of opportunities, well, there may be 4, 5, 6 years that you may never touch your dollar at all, right? So if I didn't touch my dollar at all, well, I earned $7,000 here, I earned $13,000 here, I earned $19,000 here, and it's continued earning money every single year. And I am now gaining compounding interest on my funds. And then when an opportunity presents itself because the market crashed, and I now have opportunities in real estate, the market, you have, money lending, whatever instance you have from your expertise, your business, whenever you have that ability to now take advantage of that opportunity, you now have a large lump sum of cash here, almost $1 million of funds that we can use to be able to go build more wealth. If you would have just sat on the sidelines the entire time, well, then it's just sitting there in a bank, eroding, waiting for your dollars to essentially get deployed. And once we then spend that dollar, the dollar is now gone again for the rest of our life. So in this instance, we have our dollars compounding going for the rest of our life, and we're letting it sit and compound while we're waiting for opportunities to present itself. And so this is exactly how the wealthy use it. They use it to leverage, but leverage in an appropriate manner. And then when you do produce asset-based activities, you then come back and you pay off the loan interest. So then you can borrow again to then go produce more activities, asset-based activities. All right. Hope this helped. We'll talk soon.